Welcome to another episode of the Chicks on the Right podcast, where we talk with our friend and sponsor of the show, Zach Abraham from Bulwark Capital Management. And as of the recording of this program, we saw some crazy swings in the stock market as a result of China's AI, which is apparently very competitive and cheaper than the United States open AI. And that sent stocks like scrambling, and then everything sort of leveled out, which is why we wanted to talk to you today, Zach, about what should the reaction of a regular person be when it comes to their portfolio and they see these kinds of swings? Should they be fearful of tech stocks or not?
Yes and no. So the issue with tech stocks we've been talking about. So today is a very good example of the dangers of owning some stocks that are extraordinarily expensive. Okay, so if you look at Nvidia, like a stock like Nvidia, it's getting hit one of the hardest today. Great company, but it has so much optimism built into the price of that stock that even the smallest little adjustment to those forward-looking earnings projections, they change massively, and the stock has to sell off. So generally speaking, I don't think there's a big thing. Here's the problem, though. The problem is, because of the way people have been invested, they are more exposed to these kinds of stocks than they have ever been exposed to any kind of stock. So let's just say they have an S&P 500 ETF or mutual fund. Okay, probably somewhere in the neighborhood of 40 to 50% of their holdings are companies like Nvidia and Marvell and these tech-based companies. And then what's scary in general about this market, I look at a company like Apple. Apple's up over 4% today. That's just as stupid to me as what you see going on the others. Meaning, this is what scares me about this market. This market, regardless of what's going on in the underlying economy, this market is just completely divorced from anything financial, right? So like, if you look at Apple today, it's up 4%. That's about $150 or $160 billion increase of their market cap because AI chips that they don't sell are going to go for less.
What?
It just, and it's just one day, right? You can't take one day too seriously.
Exactly.
But these are examples of how ridiculous this entire market really is. And one of the things that we've been telling people is, look, whether you're going to get hit right now or whether it's coming later, the one thing I can tell you is you are the most loaded up in the most expensive and most overrepresented sector in history. So should you have exposure to it? Yes. Should you have as much as you probably do? No, not even close. And it even gets exacerbated because not only people will own these ETFs and mutual funds that are way overrepresented by this kind of stuff, on top of it, a lot of them have bought these stocks along the way. So we'll take in portfolios all the time that are 60, 70% in those companies, right? And it's just way too much. Now, on the flip side, you're going to see a bunch of things get hit today. Again, like some of the uranium companies that we own have sold off hard. How does that really correlate to AI chips? It doesn't. But again, in a stupid market that is working. So, and I don't know what else to call it. It's just detached from reality. We said, look, a lot of this stuff's going to have to sell off. When it does, a lot of the really good, cheap, really solid fundamental stuff will sell off too. Why? Because why not? Right? So we actually see this over the short term. If you own a lot of that stuff, I think that, who knows? I mean, these stocks are still so expensive that, you look at a company like Nvidia could drop 50% and still be historically expensive, right? I mean, it's down 16% today. So I think people need to be careful, but this just gets to the risks that we're seeing out there, which we see so many great opportunities, but the problem is tech is dominated for so long that it has become the vast majority of everybody's portfolio. Should you have exposure to it? Yes, but diversity is a good thing, right?
Well, what's the percentage then? Like what would you recommend as a percentage of your entire portfolio?
The diversification percentage.
Yeah, I mean, long term, we don't ever like to exceed 25 or 30% in a sector, but for us to be that involved in a sector, we have to see extraordinarily low prices, right? Again, this is what's so pernicious about this. Not only are you so overloaded by like 40% in this sector, it's also the most expensive sector in the market, and it's the most expensive sector in the history of the market, right?
Wow.
So again, not saying the whole bottom's going to fall out tomorrow, but there's two things that are going to happen. Those stocks have made the majority of the gains that they're going to make over the next 5 to 7, meaning those stocks are not going to continue their performance over the next 5 to 7 that they have over the previous 10. They're just not. Okay. Either they won't, or those companies will all be larger than the size of the entire U.S. economy. I'm going to bet that's not going to happen. Okay. And so the other big issue, though, like we've said before, it's not so much, well, it is. It's not just a problem what you're exposed to, it's what you're not, right? That's the other problem. Not only are you 40% exposed to this sector, but what else are you not exposed to, right? And that to us is the biggest danger, because we're looking around a bunch of different sectors, a bunch of different places, and we're seeing, I was talking on our own show about a wonderful, growing, well-run, beautiful balance sheet, solidly cash flowing natural gas company that we own that's going to be right in the middle of shipping this whole surge of shipping liquid natural gas to Europe. And oh, by the way, they're also paying a 12% annual dividend, right? And so you're looking at stuff like that. You're like, man, why am I going to mess with something like NVIDIA at 25 or 30 times revenue when I'm sitting here buying these wonderful companies that are paying me 12%? There's just so much better stuff to own out there.
And go ahead.
No, it's okay. Go ahead.
Oh, I was going to say, so like when there's these giant, when you read the headlines first thing in the morning and you see, oh my God, like the futures are saying the world is ending and everything is going south. It's so tempting, I know, for people who are risk averse to be like, oh my God, I got to get rid of all my tech stocks.
Yeah.
But you're not suggesting, like, when you see a headline like that, dump everything and run for the hills. You still should be exposed, maybe just not a crazy amount, is what I'm understanding.
Yeah, and this is what's so important, right? Today is an annoying day for us because some of our stuff is getting hit right along. But why are we not concerned? We're not concerned because our stuff isn't ridiculously priced, right? Meaning, if I've got, let's say I'm buying let's say I'm buying a house right now or let's say I bought a house 5 years back, and it had only rallied 15% since the 08 or 09 lows, right? I might not be the best price out there, but I'm sitting there going, man, if this thing's only 15% off the 09 lows, I'm probably safe, right? There's probably not a lot of fluff in it. For instance, if you're buying these kinds of stocks, these AI and tech type stocks right now, it's like buying a house in 2007, right? I mean, you're just buying these things priced to perfection. It doesn't guarantee a collapse. These things have been expensive for a long time. But what it does say is, again, today should be a good reminder to people. This is why you need to make sure you have a portfolio. And guys, this cycle has gone on so long that it's to the point when we get clients that bring portfolios in, it is a rare event that you have a portfolio that is properly diversified. It's shocking. Even people that have somebody else managing their money, right? So then to get to your point, all of this is not about the failure of AI. This is not about America losing pace in the AI. This is about a Chinese firm used several lower quality, or not the most expensive chips that NVIDIA makes. They used stuff that was 2 or 3 generations old, so way cheaper, and they got outstanding results, which calls into question all of the tens and hundreds of billions of dollars that we thought so many of these tech companies were going to have to spend on these chips. Now, personally, I think the market is overreacting. What's hard about it, though, is the market has already way overreacted to the upside of AI. So where's reality in here? I don't really know, but for the majority of these companies, today is a perfect example of why we've just said we don't buy stuff that's that insanely expensive, because it's impossible to know what it's really worth.
Oh my gosh. Well, and when we say today, by the time this podcast airs, we'll have been talking about Monday, the 27th, which is when everything was so crazy with the market. And by the time this podcast airs, you will have done another webinar, which I know our listeners are huge fans of. So what can people expect out of your webinars, and where can they sign up?
Well, so we're going to walk through our general, our process and show you how we do things, and how it's all about trying to minimize risk but maximize upside potential. And in this one, we're going to show some specific charts that don't necessarily tell you exactly what's going to happen, but people need to understand where we are and how far out there we are in terms of historical norms. And it's not just about fear and risk, but it's also about opportunity, right? If we're buying things that are overpriced, it means that we're not buying things that aren't, right? There's opportunity cost to investments. So we just want to show them some of that stuff, show them what we think the risks are out there, and then also show them what we think are some unbelievable potential investments that people are ignoring. And best way to do that is just go to knowyourriskradio.com, bulwarkcapitalmanagement.com, sign up there.
Awesome. Thank you so much, Zach. We appreciate it as always.
All right. Thank you, ladies. Thanks for having me.
Thanks, Zach.
Services offered through Trek Financial LLC, an SEC registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ. Investments involve risk and are not guaranteed. Past performance doesn't guarantee future results. Trek 24308.